We have a crisis at hand that's likely to pick up speed in a way that the chaos theorist would say, aha, we've gone from incremental trend to a chaos resolution, where things unravel quickly. It's during that time that we expect to see gold and silver the bottom out of this situation and go contrary to the paper asset bubble breakage.
Hi, I'm Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for September 27th through October 4th, 2022. This week we feature two different silver sovereigns while supplies last. First, 2022 silver maples, which will likely be the last maple to feature Queen Elizabeth II. Made by the Royal Canadian Mint, the silver maple is 4 nines fine and was the first silver coin made to that exemplary purity. It comes in tubes of 25, monster boxes of 500, and is available for $6.25 over spot. Our second special is the Silver Philharmonic. Made in Austria with a face value of €1.50, the Philharmonic is the most popular silver bullion coin in Europe, and frequently regarded as the most beautiful silver sovereign currently made. It's available at $5.35 over spot. All our specials this week are IRA eligible, and if you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from olivermsa.com, Momentum Structural Analysis. Oliver, thank you so much for joining us today.
Hi, Elijah. Good to be back.
All right. Well, I wanted to start with gold because we're seeing, it seems like a lot of people are pointing out that gold has broken down below key support levels in that $1,600 range. Your perspective on where we are right now, because I know you recently wrote a report last week saying, a lot of people are saying that it could fall lower, but you don't think so. And actually, they can go to the website, olivermsa.com, email you for that report, for that sample report there. But in your opinion, why do you believe gold is not heading significantly lower?
We analyze all major four asset categories, debt markets, stock market, commodities, especially gold and silver, and the foreign exchange markets. And over the years, we have called many tops and many bottoms in all those markets. And the report I issued last weekend explains somewhat laboriously, but I think interestingly, why MSA and its methodology cannot buy into the notion that just because gold broke a very obvious price chart floor, that any idiot could plot with a crayon, okay? The last 2 years, we've had a range of action. The bottom end of that range was in March of 2021. We traded down to 1674 and then rallied. Then in August of 2021, we also got down into the 1670s and rallied. Then in July of this year, we got down into the high 1600s and rallied. And then finally, this past month, we broke through that very, very obvious price chart floor. And therefore, looking only at a price chart, you think, oh, that's a major top. Our momentum-based methods, especially we're talking long term, say, no, something's wrong here. It looks like a price top, but price is often delusional, and it'll put you in the wrong direction, especially if momentum says, no, something's wrong, and it does. We called the top in gold in 2012, actually in December of 2011 and January especially of 2012, a few months after it had made its price high. We called the low in gold in February of 2016, 2.5 months after it made its, 2 months after it had made its low in December of 2015. Now, the reason for that wasn't because we were so insightful about price. Price wasn't saying anything at that point, but our momentum work was breaking over major, what you would call structures, where if you looked at the momentum chart, you'd say, oh, it's breaking out. Price wasn't. But notice that both of those major signals that we issued occurred within months of the high. In the case of gold, its peak monthly close was in September 2011, and we were saying, screaming, it was over December into January the next year. And same in 2015 low versus our buy in 2016, literally months after the signal. This is also true with our stock market signals, major long-term signals. It's not a year or two after a high that we finally say, oh, it's no good. Well, where do we stand now? The high monthly close in gold was in July of 2020. We traded slightly higher in the month of August 2020. And since then, that was the peak monthly close. Gold's been in like a 20% trading range until it, quote, broke down this month. Now it's rallying back some right now, but we doubt that breakout in price, which everybody can see and everybody's pulling their hair out about. We doubt that it, one, is sustainable, and two, I don't think it's going to be deep. In fact, it wouldn't shock us that the low we saw this month might have been it, 1613. Right now we're trading about 1670, okay? This report deals with that. So go to our site, you'll see contact tab, and you'll see my lovely picture, okay? Below it is my email address. Just click on that, ask me for the report, you'll get it for free. Anyway, so it's a situation also that a lot of people are looking at the stock market, and they're recognizing finally, and we got bearish in January of this year, by the way, on NASDAQ 100 in February for S&P, major long-term bearish. So literally a few months off the high. And since then, we've seen a significant decline, not a collapse, but a significant decline in layers. We think it could pick up some speed here soon. In recent months, gold has joined in on that. Okay, now the same kind of thing happened back in October of 2008, when the stock market had already been a year off of its high. It was October 2008. Heck, it had peaked in October 2007. But in October 2008, it had a crash-like event in the S&P where you went down like 30-some-odd% during the month of October. At that same month, gold finally decided, I think I'll join in. And so gold, for a matter of several weeks within the month of October, collapsed with the S&P, and everybody thought, oh, it's going to continue down with the S&P. Within a few months, gold was back at its high, and a few months later, S&P was continuing to make new lows, so totally divorced, despite that breakage that scared so many people in October 2008, which we think to some extent is very similar to what we've just seen in gold now, where the price charts look terrible, but the momentum charts say, something's wrong here. Don't believe what the price chart's telling you. So we shall see. But over the coming weeks, I think a lot of the evidence that we're looking for is going to come into play, such that paper asset category, which is a broken bubble now. We had a 7-fold bull market in the S&P over the prior dozen years, up to 2021, promoted by QEs, and zero rates. And you had a 16-fold bull market in the NASDAQ 100. You've never in the history of the United States had a stock market paper asset bubble of that dimension. Even the 1923 to 1929 bull is like a tripling. The dot-com bubble was nothing compared to what we've just seen. The 2003 low to the 2007 high. When we came down in 2009, we thought it was the end of the world. It was only a doubling that we'd seen between 2003 and 2007. Here we have a 7-fold and a 16-fold, and people don't acknowledge the difference. When this thing comes apart, it's going to be horrendous. We're seeing it in other assets as well, like debt markets, not just the U.S. government T-bonds. Muni bonds are collapsing. High-yield corporate debt ETFs like HYG, JNK, they're in collapse mode. They're going down with the stock market, but they're pushing levels such that the muni bond ETF and the high-yield corporate debt ETF, closing the month where they are now, take out 10 years worth of prior low closes. 10 years. The only thing left on those is the 2009 lows. So it'd be like the S&P now down at about 2,000 or something. It's a major collapse. And so the paper asset bubble is broken. The question then is, for those who believe that the Fed is, somehow the wizard that maintains control over the universe, Are they going to continue to allow this to unfold and unravel? They pricked their bubble, their own bubble. They pricked it with a big pin. And instead of deflating inflation, they're deflating the inflation bubble that they created, paper assets. And once they recognize the consequences of that, for instance, we're seeing some of that in the UK, where they're having to come in and defend their bonds. Europe is in dire straits. China is not doing well. So a lot of paper assets are imploding around the world. Do you think the central bank here will continue to posture itself in such a way that it doesn't come to the defense of these assets? Because if they don't come to the defense of these assets, then you can have cities and states in dire straits very quickly. You're going to have pension funds unable to meet their requirements because the assets that they bought over the years recently to get higher yield are killing them, not helping them. So we have a crisis at hand that's likely to pick up speed in a way that the chaos theorist would say, aha, we've gone from incremental trend to a chaos resolution where things unravel quickly. It's during that time that we expect to see gold and silver the bottom out of this situation and go contrary to the paper asset bubble breakage. So it's something we're monitoring at MSA constantly. We think that's going to be the outcome. We're starting to see some of the evidence of that already. And so that's our function.
Now, to, I guess, summarize then what you're saying is we're seeing the stock market continue to implode, but we're going to see a reversal, not in the stock market, but in precious metals. And if you could remind our viewers some of the signs that we should be looking for that reversal.
First off, we're coming up on the end of the month and the end of a quarter. Whenever these time frames change, moving averages that we measure versus, and I don't mean overlaying them on a price chart, but oscillating price in relation to these moving averages, we're going to get some upturn signals in silver and gold. We're looking for layers of buy signals. In other words, not just one magic number, but it's likely to be several starting gates. And we're effectively right now trading at levels. If we're trading here next month, you're going to start to engage some of these even around current price levels of silver and gold. And I think you're going to start to see that divorce to where even price chart folks will be able to say, hey, stock market's continued down, but gold is somehow anchored itself and is flipping up. Now, what's going on here? It'll confuse them because a lot of people believe in that assumption that if stock market goes down, gold has to go down. It's not historically valid, technically speaking, going back through history. The correlation between the two is not that good. At best, a coin toss. Yes, there are points in time where you might get a panic in the stock market, like March of 2020. You had a panic in gold as well. But quickly, gold reversed out of that and exploded. And so did silver. Silver went from like $19 to $30 in a matter of months. So we're looking for that divorce again. And our focus is not on precious metals as such, meaning palladium and platinum, but on gold and silver, monetary metals, because we think we're facing a monetary crisis here. And it will be evident not in just emerging markets, which are suffering badly right now because of the dollar situation, which, by the way, we think is turning the other way, but the major economies, the UK, EU, Japan. And we've already seen some intervention that we've never seen before. The UK has intervened. The Japanese Bank of Japan has intervened. Wouldn't be shocked if the Treasury Department intervenes at some point, if they haven't already, without announcing it. But it's a monetary crisis, and I think gold will reflect the opposite of that. And frankly, it and silver will be the preeminent places to be as that unfolds.
When it comes to the miners, if we do see a reversal in precious metals, gold and silver, the actual metal, but then still see a fall in the stock market, where do you see the miners in that situation?
The miners are, we define them, and silver to some extent is this way too, the screaming babies of the mama gold. Okay, when gold's going up, they scream ahead. It's like having dogs on a leash, they're rushing ahead of you. Okay, and when gold goes down, even modestly, they go down a lot more. It's just the way they behave. But if in fact gold is turning here, and again, the evidence is not in yet, it will be defined in our reports specifically as each day goes by. Expect the miners in silver to snapshot, whiplash back to the upside not just in terms of price, but in terms of relative performance to gold, percent gain. And we're still of the view that if gold has a major bull market that it's already in the process of, and this has just merely been a 2-year interruption, which happens, by the way, in many of the gold bull markets, that there's a major interruption that lasts for a couple of years, then silver will whiplash far greater on the upside on a percent basis than gold. And I remind your viewers and listeners that in 50 years, going back in gold, in the early 1970s, when it was only in the bullion market, not in the futures market in the U.S., gold went up 7-fold by 1975 when it was legalized here. 7-fold. 2 other bull markets since then were 8-fold moves in the price of gold, from the 1976 low to the 1980 high, and from the 1999's price levels around 250, it went to 1920 by 2011. Took it a dozen years, but it was an 8-fold move. So gold going up 7 to 8-fold in bull markets is hardly irregular. It's done it 3 times in the past 50 years. Okay. Our bear market low was 1,050. You do the math. If it merely has another replication of the prior 3 and goes up 8-fold, it'll be $8,000 gold. Frankly, given the fundamentals and the macro technicals that we see, that wouldn't surprise us whatsoever. In fact, even more would not surprise us, because we're in a different world now than we were in the late 70s and than we were between 1999 and 2011. There's a lot of stuff going on here that is major unraveling. And the unraveling is likely to spark great panic, greater than we've ever seen among the central banks, which means what? Ongoing destruction of the real value of the money unit, period.
And speaking of the money unit, we have seen interesting valuations in a lot of the currencies recently, with the dollar going, I guess 114, I believe, and the pound really collapsing in the last week or so. And the euro is now under the value of the dollar. So we're seeing a lot of strange things happening there. How will this all be affected in this situation, in your view?
Our technical analysis of the dollar indicates it's ripe for downturn, and significant downturn. We think what we've just seen is in effect a blow-off type move, meaning not a normal incremental rise, but one that has gone to an accelerated mode, meaning very emotional. We don't think it'll persist, partly because the central banks can't allow it to persist. If it does, the financial disaster and the consequences are almost infinite, and it'd be hard to define some of them. And I think that's why the Bank of UK has gone, intervening on the pound. And by the way, over the last week, we've had a fairly sharp reversal, past couple of days, in fact, in the pound and the euro. Not so much in the yen. The yen could be a problem going down the road. But again, the yen is a small percent of the value of the dollar index. 57% of the dollar index that we quote, that's the euro. Okay, so if the euro turns, dollar turns. Dollar hit a high of 114.70 a couple of days ago. It's trading now near 112. Okay, no big deal. But for percent-wise for the dollar, it's a pretty big deal. We've got some numbers that come into play starting next month, next quarter, which means 2 trading days away. Basically down either side of 110. So we've dropped 270 points in the last 2 days. You drop another couple points, and we think top is in. And so to the extent that the recent strength in the dollar has been inverse to gold, that will end. That will benefit gold. We remind your people, your listeners, that historically, when you go back and look at major trends in the dollar over 10-year periods of time, the correlation between it and gold are not good. For example, over the last 10 or so years, the dollar has basically risen. What's gold done? It's risen. Okay, so especially since 2015. So they've been coincident. It's only recently during the sharp part of the dollar rally that it's affected gold. But if that sharp rally, that thrust, that emotional, exhaustive thrust, we think, ends, then it could end equally emotionally the other way. And I think gold senses that. So it's another variable in the mix of the gold turn that we're thinking is about to occur, is not just what happens in the paper asset category, but also in the foreign exchange markets. And so we are watching the dollar. We think it's, what you just saw drop in 2 days, you can't do that again. You do it again, it's over. You're going down. dollar index.
Now, if we do see a washout in the dollar index, as you're talking about, how is that going to impact the financial system? Because you mentioned if the dollar rises any more from where it is now, that could have disastrous impacts. But if we have a waterfall decline, what kind of impacts could that have?
It could be that the damage has already been done. In other words, you've already had so much damage done that we just haven't heard the headlines associated with it. And the central banks are aware of that. Now, they don't speak publicly about it so much as they do about we're going to be tough on rates and all that stuff. But this foreign exchange thing has put them into a crisis mode behind the scenes. And no doubt they've been on hotlines with each other talking because intervention was needed. In fact, it's been talked about, and we've had some overt intervention we know of. It could have been some more subtle intervention we don't know of. And I think the damage that may have been caused has already been caused there. The Japanese situation is one I'd watch too, because it could have more to go on the downside. And the Japanese yen has not recovered much off its low. And as you know, the Japanese have done what we did for the past dozen years. They've done it since the late 1980s. QEs, they invented them. The Bank of Japan is the prime owner of, the stock market and ETFs in Japan. So they've effectively priced every asset they can do to defend it. If their potency comes unraveled, then a lot of those paper assets come unraveled. So Japan could be a situation to watch that may be exempt from what the euro and the pound might do. And all it takes is one of these major countries having problems, financial problems, that could domino. Because what happens in Europe, what happens in China even, what happens in Japan, what happens in the UK, we can't say, oh, we're doing well. We're tied to them. Import and export wise, we're one unified world in that regard. So we can't pretend like, oh, well, our numbers look good. They won't look good. All the numbers we like to point to, like the Fed likes, the unemployment numbers and so forth, those could dramatically, in fact, it wouldn't surprise us to see those. A lot of economists are talking about unemployment maybe getting up to 4 or 5% late next year, as if it's some kind of incremental process. Wouldn't shock us if you get there in several months. A lot of stuff is unraveling right now.
Well, it'd definitely be interesting to continue to track this with you, Michael. Any last thoughts before we let you go, and where can our viewers find you online?
Well, it's olivermsa.com. And again, you go to contact and request through my email some samples. I think we're at a very pregnant time right now. Frankly, the next few weeks could be very telling in terms of the divorce of gold versus the paper assets, the possible topping of this dollar. And by the way, when you look at it, the dollar had a range with peaks just under 104, 2 prior peaks over the last 7 years. When it hit 104 in May, it went to 114. Okay, well, that's nice. Now it's 112 something. But right now at 112 something, you're up 6, 7, 8 points. It's about 7%. And it took you, six or so months to go up 7%? Now, that's big for foreign exchange markets. But, in terms of a lot of markets, it's not a big deal. But anyway, we think we could be at a hinge point here. Literally, we might see it next month, where a lot of these things we assume are happening aren't happening.
All right, Michael, once again, thank you so much for your time, and God bless.
Thanks, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.